Do you ever sit back and imagine the perfect holiday? A long weekend trip to an exotic paradise? But then you look at your bank account and you realize you can't even afford a bus fare to the nearest council park. Or maybe you're not interested in a holiday and you just want a bit of financial security. You're tired of living hand to mouth, 9 to 5 in an endless rat race? Having extra income is always a good thing. And one of the best ways to get that passive income is buying a rental property. Now, if you don't know where to start or what questions to ask, then this video is for you. We'll go through a full step-by-step guide through buying your first rental property, and hopefully by the end of this video, you'll be able to find your way to financial freedom. But before we start this video, if you find it helpful in any way, do me a little favor and hit that like button below and leave a comment for the YouTube algorithm. Just a little gesture like that makes a huge difference to the channel. So if you haven't already, hit that subscribe button below. Thanks you guys, it really means a lot, so let's dive in. Before you do anything, you want to make sure your financial goals are clear. Like we mentioned before, do you want to be able to travel? Do you want financial security? Do you want extra income? Do you want capital growth? Do you want extra income on top of your job, or do you want to quit your job completely? Do you really want to become a real estate mogul and make millions of dollars? Having clear goals will help you make decisions on your buying journey. So now you know what you want. The second thing to do is to determine your budget and cash flows. Sit down and look at your finances, your income and expenses, and determine how much you can comfortably borrow. For example, you should try avoiding borrowing more than 6 times your income. So if you earn $100,000 a year, try to limit your borrowing to no more than 6 times that, or $600,000. Remember, you'll have to make repayments on your loan. So determine how much in terms of loan repayments you're comfortable with repaying with your current income. Assume the worst case scenario here and budget if your property was empty, not being rented out for a few months. At this stage, you should be able to determine how much you'd like to earn in terms of a rental yield. Now, do remember, some properties with a higher rental yield might not have a great capital appreciation and vice versa. So this is where you want to really determine what you're after. If you're after a high yielding property that might not give you as much capital growth, or if you'd rather a lower yielding property where you're going to tip in a little bit more of your cash, but get that capital appreciation. You want to ask your questions like, how much extra do you want to make a month? How much more are you willing to spend out of your pocket in terms of upkeep and ongoings per month before it's going to put too much financial stress? Knowing this will help you start your property research process. Once you've got your budget in place, the next thing to do is talk with a mortgage broker. A mortgage broker will help look through your financial circumstances and determine the best loan that suits you. So your personal budget is to help you know how much you want to borrow, but your mortgage broker will tell you how much you can actually lend from a lender. It might be more or less than you've initially planned, but not to worry, this is where your mortgage broker will be able to advise you the best loan that's going to suit your needs. In fact, you want to keep a close relationship with your mortgage broker, as they'll be able to provide you valuable advice, as well as potentially link you with other service providers throughout the whole buying process. As well as that, ask your mortgage broker to share stories of other home buyers that have been in similar situations to yourself, and all the things that they've learned from their journeys, the good, the bad, the ugly, so you can take away and hopefully learn from other people's mistakes. The next step is to get your deposit. Now, a lot of people will recommend a 20% deposit. And look, I think it depends on your own personal situation. Why I say that, I've had clients that have had the 20% saved up before, and they've actually turned around and said, Nathan, we're actually wanting to put in a minimum deposit. We understand we're going to pay mortgage insurance, but we've got plans to put our funds elsewhere in other investments such as crypto and shares. So once again, a lot of people will say you need a 20% deposit to avoid paying mortgage insurance, but you might see the mortgage insurance as an opportunity cost to pay now so that you can keep some of your deposits spare for other ventures. As a general rule, for an investment, the minimum deposit you need is 12% plus costs such as stamp duty and other government fees such as registrations and titles. Now, having a high deposit can also mean that it's a higher safety net, and some lenders will actually see you as a safer bet, which will increase your chances of getting a loan. Once again, this is where your mortgage broker can help guide you here in making the decision what's going to be right for you as an individual circumstances based on your future plans and goals. Now, if you're not quite there with your deposit, it might be time to cut back on some expenses and raise a high deposit. Even if you can't raise that 20% deposit, like I said earlier, the minimum the banks will work with is about 12%. Now, there will be lender's mortgage insurance, but once again, think of it more as an opportunity to get into the property without having to wait years to raise that high deposit. Once again, talk to your broker. They can help you through this process and can find the best lenders that are going to suit based on the amount of deposit and what you're looking for. Now, if you're not able to come up with the deposit yourself, you may want to consider asking family for gifts or partnering with your brother or your sister, your mother or your father, and going in it together as a joint venture. So now you have your deposit, it's time to get a pre-approval. A pre-approval is an indication from a lender that they're willing to approve your loan once you find the right property. Now remember, not all pre-approvals are the same here. Some lenders, as we've said in the last, will give you a coffee shop pre-approval. They're not even worth the paper they're written on. It doesn't go to a credit assessment team. No one looks at it, it goes through a system and a system says yes. So it's really important that you do get your pre-approval properly assessed by a credit team and it's actually validated so you can feel confident, especially if you're going to go on an auction or start making offers with short finance clauses, that your finances are going to stack up. Now, pre-approvals are known by different things by different banks. Some banks call them conditional approvals, indicative approvals, approvals in principles, or home seekers. It's all the same at the end of the day, and you should get your pre-approval before you start shopping for properties. One of the things that the banks look at during the pre-approval application is your credit rating. So make sure you have a good credit score. We recommend that your credit score should be above 650 in order to give yourself the highest chance of getting an approval from a lender. Now, whilst we're on the pre-approval, there are some brokers that will give you an eligibility letter. We do them ourselves here. They are still good. They're fully verified by your broker. Check all your details, which is pretty much like doing a pre-approval, but it doesn't lock you into a lender. Now, these are good if you're looking at very specific properties, like units as an example in a city, because some banks actually have postcode restrictions where they'll blanket out a whole area and say no units in this area. Some will actually do it based on a security register, meaning that they'll look at each individual building in a certain area and say yes or no. And this is where your broker's eligibility letter might be more suitable in this circumstance. Once again, talk with your broker, work with them, and they'll help you come up with a game plan on the best way to move forward, whether it's a pre-approval or eligibility letter here. Now, during the application process, your mortgage broker will have done a credit analysis to make sure that there's no credit cards that you've forgotten about, which may impact your ability to get finances, as well as an assessment to make sure that you tick all the bank's criteria. Now we move on to the fun part, which is the property search. When finding a potential property, you want to do your research on it. Remember, the whole point of buying a property in the first place is to buy one that has potential upside where you can make money on it. So what should you look for when researching a property? The obvious thing to do is researching the price. They say you make money when you buy rather than when you sell. So this is where you want to make sure you're buying a property at a fair price. You can do research by going online and looking at recent sales of other properties with similar characteristics. You want to look at properties that have sold within 2 kilometers of the home in the same suburb. You also want to look at the same property type. So if it's a unit, house, townhouse, looking at the same properties. You also want to make sure it's got the same number of bedrooms, bathrooms, and car parks, similar size in terms of land, and the sale has occurred ideally within the last 3 months, 6 months if you need a stretch. You also want to make sure the property is in similar condition and has similar improvements. For example, if it has a pool, the other properties you're comparing with also has a pool. Research the area and surrounding areas. Is a property on a quiet or busy street? Does it have a good walk score? So check this out on walkscore.com. So when on WalkScore, you want to be looking at things like, can people easily walk to shops and restaurants from this property? Now, the higher the WalkScore is, the more attractive the property might be to potential renters. Also, look at the vacancy rate in the area. Vacancy rate is the number of properties on the market that are vacant at any one time. If the vacancy rate is low, then it means that you're going to find renters quite easily. Also, look at the average weekly rent for similar properties in the area. This is where realestate.com can be quite handy here. This will give you an indication of how much you can expect in terms of rent for the property that you might be interested in. You can use tools like realestate.com and RentPrice to help get an idea of how much the property might actually rent for in the area that you're interested in. Another very important thing to consider in your property research is to research for flood and fire. You want to make sure that the property you're interested in hasn't been subject to any floods or fires in the past. Now, real estate agents don't actually need to tell you if the property's been affected, so you want to do your own due diligence here. You can use tools online. A lot of council websites have it for both flood and fire. If the areas are affected by fire or flooding, there'll be tools that you can find to understand the likelihood of the property is going to be affected by this in the future. Now, this will also affect the insurance premiums that you're going to be paying for. We recommend to get a quote from an insurance company prior to actually putting an offer on a property to get an idea of how much the insurance premium will be, especially if you're going to cover for flood and fire. We've had clients before that have been given quotes of $5,000, $6,000, $7,000 for insurance per annum for properties, and they just felt it was way too much and going to affect their bottom line in terms of the overall profitability. This is one of those things where the more insurance you pay, the less profitable the property is actually going to be. So something to keep in mind. Now you've researched the property, you can do your cash flows. Again, you can get an idea of what you can expect in terms of rent from the property versus your expenses and mortgage repayments, as well as your maintenance. Now that you've satisfied yourself on the numbers, now it's time to do the physical inspection of the property. Now the reason why you want to inspect the property, after all, is to check it out to make sure the pictures online match the actuals when you go through the property. And sometimes it's surprising when you actually go to the property, you might see a high tension power line within 50 meters and then think, well, maybe that's not going to be good for resale in the future. So checking out the property and doing a physical inspection is always a must do. Also, when you check out the property as a physical inspection for your first inspection, you might see things that are going to be wrong with it, so you can save yourself getting the building and pest inspectors out there and moving too fast before you actually find out if it's right for you or not. Once you've inspected the property, the next step is a building and pest inspection. Now these are important and they're going to protect you from buying a lemon. Get a certified building and pest inspector to look for things like termites and structural damages to the property. After the inspection, you'll get a building and pest report. If the house has minor issues, then you can use this report as a bargaining tool to get the price down for the price. Now, this being an investment property, you might want to consider properties that don't need a lot of renovation. It doesn't mean that you can't go for a property that needs minor improvements before you get the tenants in, like painting or doing the carpets. It might mean that you stay away from properties that have major issues with it. The next step is to make an offer to the seller through the real estate agent. Now remember, in this step, if someone else is willing to pay more than you for the property, not to worry, there's always going to be another one. So don't let the fear of missing out cause you to go beyond your budget. Stick to your guns and remember your walk-away price. Also keep in mind, this is an investment property, so stick to your guns here. We've talked about it before. You make your profit when you buy, not when you sell. Now, it will suck to go through the whole process. You might be emotionally attached to this property and see it as a great opportunity, but remember, it's all part of the game. You just need to be patient and wait for the right property to come along if this one falls through. At this point, if the offer is accepted, this is where you need to get your conveyancer, who's a legal professional, to help go through the contract and execute the transaction. Now, the conveyancer job is to protect your legal interests. They'll do this by pointing out any dodgy clauses in the contract and also explain certain terms to you. A conveyancer can cost anywhere from about $800 to $1,500 depending on the complexity of the purchase as well as the amount of searches that you do. If all goes well, then congratulations, you own your first rental property. But it doesn't end there. The next step is to hire a property manager. Now this is where you want to get rid of the stress that comes along with being a landlord. Getting a property manager is always a good idea. Property managers are experts in their field and have a ton of experience. They'll help you find the right tenant by advertising the property and also doing due diligence on the tenant before you actually go ahead with them. They'll collect rent, they'll pay necessary expenses, inspect the property on a local basis, and also arrange for any maintenance to take place. Property managers are great, especially if you live out of the state and you don't have time to go and see the property on a regular basis. Some property managers will also help get your financial information together, as well as that your property manager will sum everything up at the end of each financial year, which will help with your tax returns. Which brings us on to our next point, to make sure you have your accountant in order. Now there's quite a number of tax and accounting implications when you own your own investment property. This is where having an accountant on board will help, and they'll be able to guide you through all the things that you need to be aware of before you get yourself in a sticky situation. By watching this video, you've made the right decision to take your first step into property ownership for an investment. Now it's time to put your decision in action and speak with one of our team members here that can help on your home buying journey. Get in touch with us at huntergalloway.com.au or call us on 1300 088 065 and book a free assessment. Thanks for watching, guys, and if you have any questions, leave them in the comments below, and we'll see you next time.